Hello everyone, welcome to Decode Indian Markets. In today's video, we are diving into debit spreads, one of the most powerful and beginner-friendly option strategies. I will explain what a debit spread is, how it works, when to use it, and the advantages and risks involved. We will also break it down step by step with a detailed payoff chart so you can clearly understand the profit and loss zones. So let's get started and decode debit spreads in the simplest and smartest way. So the first question is, what is a debit spread? So in a debit spread, you basically buy an option. Buying an option means you are paying a premium, right? And you sell another option which is at a different strike. Selling an option means you are getting the premium. How is it a debit spread? Because the option you are buying will have a higher price and the option you are selling will have a lower price. Lower price in the sense premium. So buying at a higher premium, selling at a lower premium. So overall, you are in a debit, buying minus selling premium. So you pay money upfront, unlike credit spread. So in credit spread, you were selling at a higher premium, buying at a lower premium, which was a credit spread, selling price, selling premium minus buying premium. Now debit spreads are directional, okay, and here also we have defined risk and defined reward, which we will see in the um, sensible when we see the payoff chart when we create the strategy. Now there are two types of debit spread, and these are bull call spread, bear put spread. Now how these naming is being done, the first word is based on the bias. So if you are biased towards upside, then you have bull. If you are biased towards downside, then you have bear. And second word is call or put, which means if you are using call legs to create the spread, it is call spread. If you are using put legs to create the spread, it is put. And spread is basically using more than one leg, so it's a spread. We will be using two call legs to create a bull call spread and two put legs to create a bear put spread. So if you see here, we are buying a call at a lower strike and sell a call at a higher strike, but the premium of buying will be more than premium of selling, so that's why it's a net debit spread, and both would be expiring on the same day. Similar thing with bear put spread. You have a premium of put at a higher strike price, which is more than the premium of sell leg, which is at a lower strike. So overall, here also you will be in a debit, and both would be expiring on the same day. Now, how debit spreads generate profits? See, in debit spread, uh, you are paying the premium, net premium. So that's why you are in debit. How this works? For example, so you buy a 100 rupees strike put option for 3 rupees, and you sell a 95 rupees strike put option for 1 rupees. So overall you are in a debit, rupees 3 minus 1, 2 rupees. You are paying 2 rupees upfront to take this trade. Okay. Now, what are the advantages? Okay, so here also you have defined risks, so maximum loss is also limited and maximum profit will also be limited. Directional leverage with lower cost. So uh, here, since we are having a sell leg as well with the buying, so if you do naked option buying for any call option or put option, here you will be having a sell leg as well, so we will get a leverage, so you will not lose exactly how you lose in naked option buying if the market goes against you. Cheaper than single long option. So if you only buy call or put, it will be cheaper. So if you are doing debit spreads, that will be cheaper than actually going long with single options, right? And since we are having sell leg again, sell leg is the hedge. So that's what it will do, is it will reduce the impact of time decay. Theta decay will be less here because we are having a hedge, which is the selling leg, and it works well in the trendy markets. So if the market is trending, then in that case these this strategy works really well. Now, what are the disadvantages? Disadvantages, the problem is that profit is limited. If you do naked buying, then you will have more profit. But here profit is limited because you have a selling leg as well, right? But you are limiting your loss as well. Here you require more accurate directional prediction. Yeah, for if you compare it with the credit spread, you would require more accurate directional spread prediction, because if it stays there or uh, doesn't move much, in that case you will not get much profit. It will profit only if the direction you are expecting it moves there, also it moves fast, right? And since the selling leg is there, so you will see time decay, theta decay, which usually works against us in this one. Lower probability of profit than credit spread. So yeah, here probability of profit will be less, because you have to have that direction where you are expecting the market to go. It should go in that direction. Okay, let's check out the spreads here. I'll be using Sensible to create the spreads. So if you go in Sensible and go to learn option strategies, so here you can see sections divided if you are bullish, bearish, neutral, and others. So I'll go to bullish and bearish and we will see our spreads here. So in bullish we have bull call spread. How do you identify it's a debit spread? See, you are buying at a higher price and selling at a lower price. So this is a debit spread, and this is biased upward, so it's a bull call spread. So if you go and see in builder, yeah, let's check that. So what we have done here is bull call spread. We are having an expiry of 18 November. We can choose any expiry based on our trade. Suppose we have we want to trade for the month end expiry, 25 10 days remaining, and let's see our view. So suppose what I'm saying is the market would go up from here. Okay, whenever the market opens, and I'm saying that the market will by end of 10 days or 15 days, the market is going to go up and cross this 26,000 level, right? In that case, if I'm sure about it that it will go up only, in that case I will create a bull call spread. So in this one, so if you see here for 25th November, I have bought a strike price of 25,900 for rupees 234 and sold 26,100 at 138. So overall buying leg minus selling leg, I am in debit of almost like 100 rupees, 94, 95 rupees, right? Now this is the premium I am paying upfront to get to open the trade. Now suppose what, as I said in the seeing the chart here, right? So as I said, market would go above 26,000, and I'm sure about it that in 10 days it will be above this, right? In that case, what I'll do is I'll create a bull call spread. Bull call spread, I'm saying the market will go at 26,000. So if you see at 26,000, I'll be making a profit of 308 rupees. And I'm saying it will go above. So above in the sense, if I go here, 26,100, I'll be making a profit of 17%, right? If the market stayed here and went down, in that case, I will not be making any profit and I'll be having a loss of 16%, 7,193, right? And if we are saying we want to have a little safer side, then what we can do is we can make it 25,800. So we will start making profit early. If you see here, right? So the screen moves closer to our current price, right? But we will be suffering more loss. Probability of profit is 55%, which is less than the credit spread. Risk reward ratio is 0.69. but you will be making profit after 26,000 from here onwards, right? And if you want to reduce the risk, you can go up. As I moved up, see 23%, 16%, right? So that's how you can reduce the risk. You can adjust accordingly how fast it can move, how slow it will move. Accordingly, you should trade. Similar thing if we go and check for the bearish. So in bearish, we will be having bear put spread. Here you can identify you're buying at a higher price, selling at a lower price. Go in up strategy builder, and here if you see, if our view is that it will go 25,700 below that, I should make profit, and it will go very fast below this, then I'll make a strategy so that it makes profit around 25,700. It starts making profit from 830 only. So if it closes above 25,700, I'll make this profit 25% profit, and I will lose only 10% in this trade and make 25% profit. But the probability of profit is less here. See, it will be same thing like how we had for the bull call spread. So if you want to increase the probability of profit, so what you can do is you can bring this a little far from the selling leg, right? So you can adjust your legs accordingly, how you want to, how much is your risk appetite, how much you want to risk, and how much you want to make profit. If you bring these legs closer, so for example if you are bringing them closer, then your probability of profit increases. See, and you'll be having less loss but less profit as well. I think in uh, next 18 November, right? So in 3 days, if you are getting around 5% profit, which is a good amount of profit, good amount of money, good probability of profit, you can trade in this way. Otherwise, we can go for credit spread if we are not sure about the speed in which the market can go. If we are not sure if it can go now or after 20 days, it can go down. So, but we are sure that it will be below this particular level, then we can go for a credit spread, as we have explained in the other video. And the margin requirement also, if you see, it's almost similar to what we had for credit spread. You will need for one lot trading in Nifty, you will need around 50,000 rupees. If you had sold it naked, then you would need 2 lakh rupees. But now if you see, we need only 50,000 rupees to trade. uh, Please let me know in the comment section how you like this video. Please like, comment, share, and subscribe to our channel for more such videos, and let me know in the comment section if you are expecting uh, any videos, any kind of videos. Of course we will be making more videos like this in coming future. Thank you so much.